Thanks for tuning into Talking Point. I'm Niraj Shah, and our guest today on a very interesting day because Venugopal Garre's views are wedged right between what's happened over the last 4 days and the RBI policy as it gets unveiled in a few minutes from now, 33 minutes from now. That's RBI Governor Shaktikanta Das entering and of course arriving in the RBI headquarters, and what he says, whether there is a change of stance or no, whether there is a commentary which is slightly more dovish or hawkish, we do not know. I think it'll be very, very important to see all of this. Well, but let's get in our guest, Venugopal Garre. He's India Head Research and MD at Bernstein Johnson on the show. Venu, good having you. I'm guessing I can address you as Venu, or should it be Venugopal?
Yeah, that's right. No, Venu is fine.
Yeah, I just remembered it from last time, but I just wanted to clarify this. So, Venu, great having you. Thanks for taking the time out. You know, I read your note with interest, wherein you mentioned that some of the kite flying or news rumors that were floating around were a very low probability. You did not assign them too much of importance in the note, and it was prescient in that sense because we now have an NDA-led government or BJP-led NDA government at the helm. What I want to understand from you is, where are you on this argument of whether there will be policy continuity and even if there is policy continuity, what's the extent of the emphasis of some of the themes that were laid out in the past continue to get that and therefore driving investor attention?
Yeah, so that's right. See, the starting point of any analysis right now was to figure out who's going to be in power, right? And that's a call that we all had to take, even if it sort of gets tweaked over time. So we took that call that most of the coalition partners were pre-poll alliances, and hence the reason for NDA to remain intact, and that's the reason why we believe the majority was a real majority. Of course, it will always be give and take in terms of what discussions go on behind in terms of ministerial allocations and things. May not be too material given that it's eventually NDA which is going to be running, and probably PM Modi who is going to be in power right as soon as he swears in the next couple of days. So the reality is, if that is going to be the picture, I really don't think there is going to be any material change with ideologies and policies, right? So if the flavor of NDA over the last decade, not just the last decade, 1990 to 2004, as well was about productivity, about investments, about generating new sources of economic growth for India, I think that is going to remain as a driver in terms of how things will shape up. Now, interestingly, when we wrote that, it was on a day when things looked, pretty confusing for the market. But later on, when we were listening to PM Modi's speech as well in the night, and interestingly, the commentary was all about manufacturing, semiconductors. It was about green energy and mobility and stuff like that. So it was very clear that that's the direction in which things will remain as far as the script is concerned.
Okay. So, Venu, would just trying to understand, right? And I'm not. There's nobody to blame because I can imagine how difficult your job would have been the last 3-4 days, because you were working with different permutations and combinations almost every single day, Monday, Tuesday, Wednesday, right? I couldn't envy you at all. The question really is now, however, what has been the client feedback to your notes as you've given them about what is the India stance now? Because, I mean, maybe it is a lot of factors here, but we've seen some serious, nearly $3 billion worth of selling that has happened from the FIIs in the last 3 days alone. And it's not that FIIs were lock, stock, barrel into India. This year, they've largely been flattish, right? So what has been the client feedback? And how do you think emerging market dedicated funds or otherwise, or even India-specific global clients turn back to India? Because as we learn, even the EM mandate, I mean, the FIs are largely underweight India per se.
Yeah, so Niraj, I think I do agree that it might appear as very tough for everyone the last couple of days, but at the end of the day, we all work on scenarios and we assign probabilities to scenarios. That's how we typically operate and take those calls on where things will be more realistic. But the reality is that this entire construct of continuity of power that we have got in a very different form at this juncture and the potential implications of this with respect to policy tweaks, not about the next 3 months, but probably over the next couple of years, is something which is still bothering a lot of investors globally. Because all the questions that I've got over the last couple of days has been more centered around stability, what could be the risks around that, and would there be a larger subsidy flavor to the budget and going forward, or would that one of the things that you had also raised earlier was about potentially capex getting cut. So in fact, these are the range of questions we've been getting. It's not just about just international investors, it's across the board from all investors.
Okay, and you told me that when you heard the speech, etc. I mean, some of the themes that have been in focus. Sorry, I'm focusing a bit on elections right now. Then we'll move on to the other aspects too. But because it is top front and center, you mentioned that some of the themes that you saw gave you probably the confidence that some of the things may continue as well. The argument, therefore, is on the other question is on valuations, wherein I wonder if you as a house have reduced the premium that is attached to India vis-a-vis its own history or to relative to EMs, even by a notch, because of a coalition government versus a full-blown majority to a party. Has that happened or not really?
Yeah, so in fact, we did not change. So what it means is that we maintained our multiples intact with a broader theory that policies will not change. The broader approach to economy will not change. Things around fiscal consolidation will still remain as an important key mandate. So we didn't really feel there was a change with the reason for us to change the broader target multiple for India. Another underlying factor was eventually about taking a call on earnings growth. Part of the earnings growth for us over the next few years is also driven by a lot of cycles. So we had to potentially assume that a lot of these cycles continue in a very similar fashion, leading us to the kind of earnings growth that is built into the market. So this is the reason we haven't changed. Yes, the operating word coalition politics, of course, is going to be something which a lot of investors, including us, would watch over time. But this was too early to sort of tweak.
Got it. Okay. So if developments happen at that point of time, if there is a need to do it, you might do it, but otherwise there is no need to do it. Okay. Fair point. I hope I summarized that correctly, Venu.
That's right.
Okay. Now, the other aspect is that there is a particular kitty which is available for the government to spend on various things. The belief before the elections was that it will be largely towards the capex theme, which has been so strong, and albeit from the RBI bonanza, some bit of it used for fiscal deficit, so on and so forth. Let's assume that they don't tinker too much with the fiscal deficit because this government has shown that resilience on the fisc path for sure. Therefore, out of the remaining, they have, if it was 100 rupees, the belief was that, let's say 100 rupees was going towards capex. Some people have put forth the thought that could some of it, and we are building out a hypothesis here, but could some of it be diverted towards consumption, towards rural, and therefore will the capex pie coming off a little bit impede the valuations that some of the capex themes are trading at? It might still be a reasonably large spend, but not as large a spend that enables people to give sky-high valuations to some of the capex themes. I mean, just for illustration, I mean, just so that my viewers understand, the ABB Siemens of the world ran through, right, and trading at astronomical valuations. Can that sustain, or could that come under question mark, Venu?
Okay, so interestingly, if you were to look at my theory around this entire capex versus subsidies, as well as capex on its own, is that look, capex growth firstly has already moderated, and that's not a bad sign. That's basically a reflection of how things will be in the next few years. If you look at the previous years of government budget, they were running at 25 to 30% capex growth. For the interim budget that you saw as well, which came through, the broader target after looking at the rebasing of previous year was about 17% growth. Of course, numbers would change as the actual numbers come out, but 30 went to 17. And if we actually dissect further the entire capex and look at it in terms of the important drivers for capex, things like transportation, be it road, railways, and other aspects, they were not really growing even at 17. They were sub 10%. So what does it tell you? That the market actually looked at and said there's nothing to worry, because the entire flavor of capex is going to be shifting from government to private over time. And more importantly, it's going to shift just from transportation alone, where a lot of work has already done, towards power sector, which is primarily invested by also the private sector. Its government is not the only one which does the heavy lifting out there. So you don't really need too much budgetary allocations. And more importantly, industrial capex cycle is always something which happens with a lag to economic recovery, right? So that's something which you don't really need to worry about. It just comes through on its own. So if the capex flavor is going to change over time, government dependence is going to change over time. Firstly, there's no need to worry about the allocations going forward in any case. So that is a different topic altogether, right? That was the stance. Number two is I somehow feel that there is no need to go around and give sort of specific dole outs and subsidies. I actually find it quite odd to even think about what might happen. So what are they going to do? They will put some income scheme saying I'm going to put $20 billion to the poor. How does it help the economy? Those are just episodic 1-2 month schemes or whatever. It help you for a few months. It has zero economic impact long term. In fact, productivity wise, it's going to be very damaging. Ideologically, these kind of things are very bad for the economy. I don't think that ideology is going to change. While you could relook at certain things, especially around agriculture, for example, which may not necessarily be part of the budget. How do we make agriculture more viable for the farmers, less dependent on monsoons, which of course needs a lot of infrastructure investments as well. It's an area where if we invest, that makes it more sustainable. And remember, the backdrop is we're heading into decent monsoons. So, a lot of that pressure also sort of tends to reduce if your crop output growth is also high, right? So putting all this into picture, I'm not in the camp that it's going to be taken off capex, even if you have a slightly higher social flavored budget, but it is not going to be impacting your capex or a fiscal deficit number. You already mentioned RBI buffers and other things, which is anyways going to be supportive to fiscal deficit.
Got it. And yeah, in fact, your note suggests some bit of that, right? That even if some bit goes towards social schemes, in some sense, there might not be too much of a problem. So, Venu, I'm just repeating this so that I understand it's better and maybe my viewer too, that private capex in all probability will come to the fore, and are the beneficiaries of a private capex cycle or a cycle driven both by public and private capex different than what beneficiaries are of purely a government driven capex cycle?
Yeah, so see, when end markets change, there are of course some common beneficiaries always, but the beneficiaries of course tweak and change. So for example, think of it this way: if the entire focus was only on railways, and of course you would have railway specific companies do well. The entire focus was on defense companies would do well. There's no overlap between a defense company and a railway company and vice versa. While if you're going to be focusing a lot more towards power, where we have deficits and we do foresee deficits increasing over time, then it's the power supply chain, power financiers. A lot of things basically change. Now there are some common companies, which operate across these end markets. And there are very few of them. So, for example, Larsen and Toubro will be a common company which operates across end markets. Some of the generic MNCs, have some bit of a power flavor, but they do a lot of automation things which are related to some part of infrastructure as well. So they may not be like top of the charts, but not as deeply impacted because they have exposure to power as well. So the MNC names you mentioned, for example, putting valuations aside, of course, because those are obscenely high, but that's a different topic altogether. So yes, beneficiaries do get changed over time.
Okay. So that's one aspect. I'm just curious to understand, you guys have very large clients, but when material changes into allies happen sorry, this is the last question on elections. Yeah, lest you think that this is an election focused conversation, it's not. But just one last question. Because allies get changed materially, right? There is a large state of Andhra Pradesh that is an ally and will be an important one. Bihar will be an ally and important one. Do clients try and ask you about what do you think about beneficiaries of something like this, of a large key ally, because it's a 5-year term, etc. And are there things like this? Because we've for example seen in the last few days some TDP linked names doing really well. I believe that Andhra focused cement names could do well. But I'm just trying to understand: do you get asked these things? Do you even try and venture into these things? And if so, what are your thoughts here?
Well, that's a fair question. These kind of thoughts come into everyone's minds, right? How to make quick returns on those kind of strategies. So the reality is people do ask. But the thinking always is medium to short term and not from a long term perspective, right? So and I do believe that sometimes these kind of trades do work, and especially Andhra, which is a state which is going to be, I think, progressively benefiting materially in the next few years, because the the new dispensation, which is TDP, is pretty much an investment oriented and a pretty growth focused party, as well as from point of view of how they been in the state in the past. So there will always be this rush to figure out who are the beneficiaries of potential infrastructure spends around that state, and maybe that's not a wrong approach. Don't want to make specific names out here, but this is a part and parcel of how investors look at the thesis.
Got it. Now, Venu, beyond this, what are the more important factors for market? Would you look at earnings growth? Everybody does, but is that the defining factor, or do you think what global policymakers do and thereby what RBI follows will be the more impactful factor, or is it something else?
So I think the most important factor out here is ensuring that the government, sort of gets into place. People are going to also look at ministries and figure out what kind of who are the ministers, even though I had originally felt that was not relevant. And I think that's something which people are going to focus on. And more importantly, remember, nobody's talking about it at this juncture. There was supposed to be a 100-day agenda after elections. So I don't think that has been sort of shelved. You're probably going to be hearing that as well in the next couple of weeks, which is more of the economic agendas, both for the near term and for the next 5 years, which is more a vision for the next 5 years. And then you have the budget. So I think what's going to happen is all of this is going to be the most important driver for how investors and us would sort of look at the earnings growth trajectory and landscape and tweak that over time. Nothing is going to change for this year, of course. It's more about how one would look at probably 18 months or 24 months from now in terms of earnings trajectory. Global factors are always important, so, and for us, the linkage is more about what happens to commodities and crude, and if that's going to change anything materially. To some extent, how the rate cycles shape up would have an influence on how we would also probably, go ahead in terms of our thinking. But that's not like too material at this juncture as a market moving driver.
Okay. The policy may not do too much today, Venu, but could the policy be a driver, or because the Fed rate cuts are anticipated, as far as most reports go, only in 2025, that the policy becomes a non-event from a market's perspective for the better part of the calendar?
Yeah, look, fag end of the year, let's see how policies probably pick up in terms of importance. You would also have a fiscal deficit sort of idea, borrowing calendar and things, even though I think there's nothing to worry about. So, the interesting thing I would want to watch is how does RBI interpret GDP growth rate? That's the main thing to watch. Are they going to be excited about the 8% growth, or look at the real reality that GDP growth or GVA has been moderating over the last 4 quarters to just 6.3%? So I want to basically see that interpretation, because that would have a material impact on how things would be in terms of how they look at policy as well.
Yeah, that's true. That's true. No, and that's a very important aspect that you've kind of brought out as well. So Venu, let's assume that if you were to look at this GDP GVA number and then try and correlate it as to where is it that growth might sustain. Valuations is a separate argument. I'm just talking about growth and thereby earnings growth following suit. Where is it that you guys have the highest conviction of earnings growth over the course of the next 12 to 18 months?
See, the reality is the conviction is more in areas which are order driven. So we're very confident about the capex side of things, where things will be good. Manufacturing stories, even though they are more mid capish driven, those will be decent. Autos have also got a decent earnings growth landscape, but it is moderating. But then I don't really see any negative surprises to what is being already expected in terms of moderation of growth. Financials will be relatively stable in our view. So these are probably the areas where we're generally okay with, the earnings growth landscape. So there are a lot of areas where there could be risks. And see, look, the risks are going to be more centered around how consumption shapes up, because that's an area where things have been a bit weak in the last couple of years. We also need to see how commodities move. Of course, that could have some influence in how growth rates sort of shape up in terms of earnings. So those are like external risks that we need to sort of measure. ID services is a bit tricky, honestly, even though we've already seen a pretty large downward revision in terms of growth rates and expectations over the years. So we are like scraping the bottom out there in terms of growth, but then there is no comfort or guarantee that you're going to see a major lift or an upgrade revision out there. So that's like that, again, a weaker area where we need to watch.
Right. Venu, hi, it's also Samina joining in. You've talked about the larger macro picture and the outlook on the markets, but let's talk stocks and sectors, right? Banks has been put out as a sector that may take the lead from here on. How do you feel about banks, and also what are your thoughts on PSU versus private? Where does your bias sit?
Okay, so my broader thinking process out here is financial sector has been lagging the market for a while, despite the fact that I think we are heading into a pretty decent credit growth cycle and a low credit risk cycle. Any credit risk that comes in, of course, will come in over time, but not right now. So it was primarily more about regulatory actions, concerns around interest rate trajectory and NIMs, which is what was playing on the entire thought process of how to look at the entire financial sector. To some degree, it underperformed broadly. So, my thinking is that with continuity, with policies, of course, assuming remains same, the entire earnings growth trajectory remaining same, GDP macro remaining healthy, putting all this into picture from a valuations construct, it does appear as one of those sectors which really needs to move up and generate returns for investors. So we are positive on the financial sector from that perspective. Now, the second iteration out here is PSU versus private. Typical conversation. See, our house view would be very different. When I say house view, is strategy would be very different from a sector view. I'll put sector view aside. I'll tell you my thought process. My thought process is, look, if I put broadly, a PSU and a private sector bank into a very similar pedestal, the usual challenge has been on PSUs has been more about credit risk. Uh, that's a historic issue that you used to have, and more importantly, the fact that private banks were in a broader space where you would gain share from being smaller, and they would be gaining share from the PSUs. But having said that, the reality is when you look at the broader cycle from a growth standpoint, if you're going to be heading into a corporate lending cycle, PSUs also have a key benefit in terms of being able to drive growth because of that cycle. Because a lot of private sector banks basically are moving away from a lot of infrastructure lending or such kind of things into more consumer-oriented areas, right? Where they have sort of been focusing on in the last few years. From one bank, it's now almost every private bank talking about that. So I would not really put the PSU banking space aside completely, right? So it's not like untouchable anymore. We will have to take specific bottom-up calls out there and consider them as a very important investment candidate. So I would leave it at that in terms of my approach towards the banking sector.
Also, Venu, one other space that we are suddenly seeing a return in terms of flavor of the street is consumption. With the kind of victory that the NDA has come with, there is an expectation that there could be some populist measures as well around the corner, and rural consumption may be a good space to hide in. Do you feel the same? Do you feel like even though numbers don't reflect it just yet, FMCG consumption could be a good space to start adding or allocating to at this juncture?
So you're right. There's a trading-oriented philosophy around that you're probably going to be seeing more social schemes and more transfers of wealth to rural. But remember, you also have another situation where monsoons should be okay, right? So this is all combining together a thought process that maybe you should play some of these consumption plays linked to rural. See, the approach could be very different. Firstly, I don't think these are sustainable trades, honestly, because I don't really believe there's going to be sustainable money transfers that's going to happen. Yes, over time, you can argue that in the next couple of years, you're going to be strengthening the mid to bottom end of the income pyramid, of course, through employment or other schemes around SMEs and others. But the reality is that it's typical of any cycle. You see 2099 to 2004 and beyond as well. The reality is that most of consumption names, including consumer staples, started to see volume growth strengthen only after 2007-8, after a couple of years of strengthening of the economy. I don't think this era is going to be very different. You're going to be seeing natural and organic improvement in volume growth rates after a couple of years. So anything you do right now with respect to rural or thinking about entering into extremely costly consumer staple companies, which are already pricing in a recovery and already embedding a very high long-term growth rates, is just a trade than anything else. And I would probably argue the better way to look at is from time to time look at discretionary. That is the future, in terms of how consumption sector is going to move. Discretionary is basically you could be in durables or parts and parcels of autos or some discretionary areas. Long-term thinking, I think that is what one should be focusing.
Right, thank you, Venu. It's always good getting your perspective. That's the Bernstein view on Indian equities and sectors that they're constructive on. We'll hopefully catch you soon. In the meantime, the markets are doing okay, actually. 22,924, soon 23,000 could be hit on the index. We caught up with Neelkant Mishra of Axis Bank, who talks about the various challenges in the IT space. He spoke to us exclusively at the NDTV Profits Invest 2029. Listen into that and we'll come back and, of course, start off coverage on the RBI policy meet.
Fundamentally, there are two issues with the IT sector. So I don't expect a two-quarter turnaround, to give you a simple answer. The first is that there was a period of over-investment that happened in the sector globally between 2021 and 22. Right? If you remember, all of us thought that only virtual meetings will happen and everything will be digital and app-based and all that. So what is happening now is that many of these companies, Indian companies, are benefiting from or are getting these large orders. So everyone is tracking the order inflows and sign-ups, and they are extrapolating into revenues. But what is happening is that within those companies, there are a lot of project cancellations. So the companies are saying, oh, this is not necessary. And frankly, as the US economy slows down, so it is now starting to slow down, there are visible signs, I think the pain for this sector could actually intensify, is my view. Mm-hmm. The second factor is that they are starting to see more competition. So, with the rise of the global capability centers, as companies are becoming more and more comfortable with the position in India, they are becoming comfortable with the Indian infrastructure and a lot of other things, they are starting to shift to India. So they are poaching senior people, they are paying much better salaries, and in many cases the negotiation is becoming harder because those guys are sitting in India and negotiating with you. So I think both of these are not easy to handle issues, and the sector is still expensive. See, it's a very good sector to be part of, high cash flows, professionally managed, very clean accounting and all of that. But I think the PE multiples are still too high for us to be of interest. And I don't think we are done with the cuts yet. So I think that there is another couple of quarters of cuts before things really bottom out.